Good evening and welcome. I'm Mamta Rawat from the Corporate Communications team of CareEdge. I welcome you to our discussion today on electrifying public transport, the e-bus revolution. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Hemanth Kundavaram, CFO at PMI Electro Mobility Solutions Private Limited. Mr. Shinivasa R. Naraayan, CFO at OM Global Mobility Private Limited. Mr. Vivek Gupta, CFO at JBM Auto Limited. This session will be moderated by Hardik Shah, Director at CareEdge Ratings. We will commence the session with the presentation by Arti Roy, Associate Director at CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in your panel. We will take up your queries at the end of the discussion. Now, may I invite Arti to make the presentation.
Thank you, Mamta, for the quick introduction. Good evening, everyone. I once again welcome our elite panel members who have joined us today. Let me begin the presentation with the key messages. The electric bus sector in India, though still in its early stages, is gaining traction, especially in urban areas. During FY24, electric buses reached 3,644 units, recording 81% year-on-year growth. India has over 11,000 electric buses in operation, with market penetration expected to rise from current 4% in FY24 to 9% by FY26 and probably 15% by FY27. Electric buses are significant cost savings over their operational life due to the lower maintenance and fuel cost, which also enhances their operational efficiency, making them more economically viable for the fleet owners. Government policies and incentives are very crucial for the long-term growth for electric bus industry, and the same is expected to continue in the medium term. Significant investment are being made to develop EV charging infrastructure across the country. The development of a comprehensive charging network, particularly with fast charging stations, is essential to ensure seamless intercity travel. Also, the private bus industry, which makes up nearly 93% of the total buses, will require more incentives for faster e-bus penetration. Despite the advantages of the gross cost contract model, the state transport undertaking STUs faced financial constraints leading to elongated payment cycles. The payment security mechanism, which was brought under the PM e-bus Seva, aims to address these issues by ensuring timely payments to operators, mitigating the financial risk. Before we dive into a detailed discussion, I would like to outline the topics that we will cover. We will begin with a comprehensive analysis of the global and the Indian electric bus industry. Given China's dominant role in the global electric bus industry, we will examine India's current position and the growth potential we have. We will also discuss the medium-term demand outlook for electric buses, analyze the total cost of ownership, comparing between the diesel and the EV buses, and also review the trends in the battery prices. After analyzing these industry trends, we will also consider the key initiatives undertaken by the Government of India to promote the electric bus through various schemes. We will also cover on the long-term growth drivers that are likely to play a crucial role in establishing a robust growth trajectory for electric buses as the industry navigates a path to success, overcoming the near-term challenges. Finally, we will also highlight key monitorables going forward. So let's take a look at the global scenario. As seen from the left-hand side upper chart, there were nearly 50,000 e-bus sales in calendar year 23, wherein China is a dominant force. China alone accounted up to 90% of the global electric bus sales in 2020. By 2023, this share dropped to 60%. Now that was mainly because of the decrease in the domestic demand for both EV and the normal internal combustion engine, mainly because of the COVID and also the end of the purchase subsidies for EV buses in 2022. As we can see from the left-hand lower chart, global e-bus stock stands at around 6,35,000 by the end of calendar year 23, wherein again China is a clear leader. And if we look at the right-hand side upper chart, in 2023, electric buses constituted 3% of the total global bus sales, providing significant potential. Now, over the years, the electric bus stock share has been rising across various regions, as we can see from the right-hand side lower chart. And as you see, as on December 2023, China had an electric bus stock share of almost 25%, Europe had 2%, United States at 1%, whereas India was less than 1%. Moving to India, the Indian bus industry was among the last to recover from the COVID-19 pandemic. As we see in the chart on the left-hand side, after a sharp decline in FY21 due to the pandemic, the industry experienced marginal volume growth in FY22. Following the setbacks during FY21 and 22, the industry saw a recovery path in the next 2 years, that was FY23 and 24. However, FY24 volumes remained below the pre-COVID level of 110,000 units. So going ahead, the industry is expected to surpass pre-COVID volumes by the end of FY25. Now, again, for the electric bus sector in India, it is still at a very early stages, which represents just 4% of the total annual bus registration, which is very visible from the right-hand side chart. However, electric buses are gradually gaining traction, particularly in urban areas. And during FY24, the total sales of electric buses in India reached to 3,644 units, marking a nearly 81% year-on-year growth. We shall discuss the reasons for this surge in the subsequent slides. Coming to breakup in India, now let's take a look at the leading states who have been adopting the electric bus in India. So as on December 2024, Maharashtra is the leading state in electric bus registrations with nearly 2,423 registrations. Delhi follows closely at around 2,361 and Karnataka ranks third. Again, within these states, the major concentration were in some of the prime cities like Delhi, Mumbai, Bangalore, Hyderabad, Pune, etc. These states are driving the growth of electric buses in India through supportive policies from the government, the infrastructure development that is happening, and obviously the increasing awareness of the environmental benefits. Moving ahead, India has a huge potential for EV buses, and this we would like to exhibit from this slide. As seen in the left-hand side upper chart, currently, India has 15 buses per 1,000 people, which is way below the global average of 24, which is comparable lower than the other countries. Additionally, as seen in the left-hand side lower chart, there is significant disparity among the Indian state as well. Karnataka leads with 40 buses per 10,000, followed by Delhi, Maharashtra, Gujarat, and last Uttar Pradesh. Again, on the right-hand side upper chart, India has 6 electric buses per million people compared to global average, which is about 85 e-buses, providing significant potential in India. Looking at state-wise, on the right-hand side lower chart, Delhi leads Indian states with 126 electric buses per million, followed by Karnataka at 28. While global cities are prioritizing their transport system with e-buses, India has yet to fully capitalize on this opportunity in a big way. Now, the demand for the EV buses is also driven by a shift towards the greener fuel. As seen in the right-hand side upper chart, diesel and petrol, which dominated the bus industry, they have seen a sharp drop from 97-98% a decade ago to around 90% in FY24 and 9-month FY25. Also, if we look at the right-hand side lower chart, cleaner fuels like CNG and electric have grown from 2 to 3% to around 10% in FY24 and in 9-month FY25. CNG, cleaner than diesel and petrol, helps reduce the urban air pollution, while electric buses, which are a bit costlier, are even cleaner. Electric buses made up 4% of total bus volumes in FY23 to FY25. As can be seen on the right-hand side lower chart, the temporary rise to 14% during FY22 and 23 was mainly due to the lower overall bus volume post the COVID-19. This trend is expected to accelerate in FY26 and FY27 with more electric buses on the road. Now let's analyze the total cost of ownership comparison between diesel and electric buses, which is one of the major factors for industry to move towards EV buses. Examining the TCO per kilometer, excluding the government subsidies, it uncovers some interesting facts. For electric buses, capital and financing costs are high, whereas for diesel buses, fuel and maintenance costs are high. Now, over a period of 12 years, the TCO for an AC electric bus is about 12 to 15%, which is lower than AC diesel buses, and with potential for greater savings as diesel prices keeps rising and the battery prices are coming down. Now, declining battery prices will further reduce the TCO for electric buses, making them more attractive. A long-term TCO difference of 20 to 25% can significantly impact margins on the positive side and drive the shift towards the EV buses. The other major cost for EVs is the battery, which accounts for 40 to 50% of the upfront cost in electric buses. These batteries, crucial for performance and lifespan, ideally last 5 to 7 years. Over the past decade, lithium-ion battery costs have significantly declined due to the technological advancement and economies of scale. Now, in 2024, the global average price dropped by 20% to $115 per kilowatt, with EV battery prices falling below $100 per kilowatt for the first time. Now, this cost reduction has made EVs more affordable. Now, also let's discuss the current EV bus procurement model that is going in India. So currently there are two models that has been followed. One is outright purchase model and the gross cost contract, the GCC model. In the traditional outright purchase model, the bus agency owns, operates, and maintains the buses. Historically, this was the standard approach for bus procurement. Now, the introduction of electric bus procurement in India through the GCC model began with FAME 1 scheme. Some more highlight on the GCC procurement. So service provider, which is OEMs or the consortium or the SPVs, own, operate and maintain the buses for a predetermined rate per kilometer under the contract period. Service providers are compensated for a minimum assured number of kilometers based on the bus availability and do not bear the traffic or demand risk. For unutilized or excess kilometers, a pre-decided low fixed rate per kilometer is paid. So basically, the financial and operational risk are shared between the service provider and the bus agency. This GCC model eliminates the need for initial capital investment by bus agency and compensates the service provider for a minimum assured number of kilometers, eliminating the traffic risk. One downside of the GCC model for bus agency is the sizable fixed payout, irrespective of the kilometers run, whereas service providers face counterparty risk throughout the duration of the contract. This GCC model has actually helped in accelerating the adoption of electric buses, especially with the STUs. Now let's see who are the major players in the industry. So currently, the Indian electric bus industry is dominated by few players, including Tata Motors, Switch Mobility, Electro, JBM, and PMI, which held almost 88% of the market share in FY24. Market share fluctuates based on the delivery schedules from the competitive bidding for GCC model contracts. The competitive landscape limits pricing power due to the tender-based nature, with industry players mainly serving STUs under the GCC model. Now, going ahead, the electric bus industry is set to grow significantly, with volumes expected to rise from the current 3,644 units, which was recorded in FY24, to approx 17,100 units in FY27, and the penetration rate increasing to 15%, which is currently about 4%. This growth is driven by strong government support and incentives, along with the TCO in favor of e-buses. The Indian electric bus industry is well equipped to meet the growing demand in the medium term. For example, as we see in the chart on the left-hand side, 5 companies, which collectively held the 88% market share in FY24, have the capacity to manufacture approximately more than 40,500 electric buses annually. Demand growth is further supported by a robust order book among the industry players. Notably, as seen in the chart on the right-hand side, some of the four companies which held a combined market share of 40% in FY24, they had an order book of approximately 20,000 electric buses as on September 2024, again set to be delivered within the next 1 to 2 years. Against this expected volume growth for EV buses, what lies for the financial sector or lenders? The projected growth in the electric bus market will lead to a substantial increase in demand for financing. During FY24, the incremental term debt size of the electric bus industry was approximately 3,600 crore. This figure is expected to increase more than 17,800 crore by FY27, driven by the anticipated increase in e-bus volumes. Going ahead, in this slide, we will be discussing schemes that has been supporting the drive for EV. Government of India has adopted many schemes to boost the adoption of electric buses in the country. Initially, incentives were provided under FAME 1 and 2, which have ended. The current schemes, the PM E-Bus Seva scheme aims to deploy 10,000 electric buses with an estimated cost of Rs 57,613 crore. The central government funds 20,000 crore and the rest will be covered by the state government. In September 2024, the Union Cabinet approved the PM E-Bus Seva Payment Security Mechanism with an outlay of 3,435 crore. This scheme supports the procurement and operation of over 38,000 electric buses from the period of FY25 to 29 and ensuring operations of up to 12 years. The PM E-Drive scheme, launched in September 2024, has a financial outlay of Rs 10,900 crore. It aims to provide demand incentives for 28.81 lakh electric vehicles, including 14,028 electric buses with a Rs 10,000 per kilowatt incentive for buses. Additionally, Rs 2,000 crore is allocated to establish 72,300 public charges and including 1,800 for e-buses. The government policies and incentives are key drivers of the long-term growth in electric bus industry. Financial incentives reduce the initial cost, making electric buses more affordable, and government support is expected to continue in the foreseeable period. Electric buses offer significant cost savings over their operational life compared to diesel buses, which is expected to fast-track the e-bus penetration. With fewer moving parts, operational efficiency of e-buses is superior compared to the diesel buses. India's urban population has been rising, and it has rose from 377 million in 2011 to 519 million in 2023. This demographic shift pressures urban transport systems, highlighting the need for cleaner, more efficient transportation solutions. In this backdrop, electric buses with lower emissions are a favorable option. Technological advancement in battery technology have led to improved energy storage capacity, longer driving range, and faster charging time for electric buses. These advancements are likely to address few initial concerns with e-buses. Let's see what are the key challenges for electric bus industry. Currently, inadequate infrastructure is a significant barrier. At present, charging infrastructure is limited to a few developed cities. Expanding this network is taking substantial time, which is limiting the e-bus penetration. Due to low ticketing revenue and the generally challenging financial situations of the SUs, the operators also face the counterparty risk. Assuring operators about the timely payment scheme is critical. The private bus industry constitutes about 93% of the total buses on Indian roads, but this segment has very little government incentives, unlike the SUs, again limiting the mass adoption of e-buses. Let's see what are the key monitorables going forward for electric bus industry, which needs to be monitored. First, battery life and the replacement cost would be important to monitor, as it would be affecting the TCO of an e-bus. If the battery life turns out as per the promise and the battery prices keep declining, E-buses would be more economical and would be a preferred choice. Counterparty risk is a key challenge for electric bus. And in order to mitigate, it will be interesting to see the proper functioning of the recently announced payment security mechanism. As mentioned earlier, weak charging infrastructure is a major barrier for electric buses. Investing in fast charging stations is crucial to facilitate the smooth travel. Electric buses cost higher than diesel buses, making the upfront cost prohibitive for small operators. The private bus industry has a negligible rate of electrification due to the lack of incentives for the private players, leading to minimal adoption. Growth in EV buses in private sector can be a game changer, driving the volume growth and will remain key monitorables. With this, I conclude the presentation over here. Over to you, Mamta.
Thank you, Arti. Attendees are requested to key in your questions, which we will take up after our panel discussion. Now, may I invite Hardik Shah to take over the session, please. Hardik Shah is a qualified chartered accountant and a CFA, currently serving as Director and Rating Head at CareEdge Ratings, and has over 19 years of industry experience with a focus on corporate credit ratings. At CareEdge Ratings, he has led various rating teams across diverse sectors. Over to you, Hardik.
Thank you, Mamta, for the quick introduction and Arti for an insightful presentation. Good evening and very warm welcome to everyone who has joined us today for this webinar. We welcome our esteemed guest speakers for today. So let me introduce the speakers in an alphabetical order. Our first guest speaker for today is Mr. Hemanth Kundavaram. Hemanth is associated with PMI as a CFO. He has rich experience of over 2 decades across finance, accounts, tax management, compliances, secretarial and investor relations. He has previously worked at recognized organizations such as Hero Electric, MedPlus, Dodla Group, Rockwell Collins, Thomson Reuters, and IBM. Hemanth is a qualified chartered accountant. A very warm welcome to you, Hemanth. Our second guest speaker for today is Mr. Shinivasa Naraayan. Shini is associated with OM as a CFO. He has rich experience of over 25 years in the field of finance. His experience hover around 8 years in the FMCG sector and rest in the automotive sector. Since 2017, he has been a core member of Ashok Leyland's EV team since its inception. Shini is also a qualified chartered accountant. A very warm welcome to you, Shini. Our third guest speaker for today is Mr. Vivek Gupta. Vivek is associated with JBM Auto as a CFO. He has rich experience of over 27 years in corporate finance and strategy, and he has been with JBM for the last 23 years. He played a pivotal role in the growth of JBM Auto. Vivek is a qualified chartered accountant, cost and management accountant, and company secretary. He has also completed the VLFM leadership program. A very warm welcome to you, Vivek. My sincere thanks to our guest speakers for joining this session. It's time to quickly set the context before we begin. So as we saw in the presentation that currently the share of EV bus is very low in the overall bus segment in the country. However, the traction which we have seen in the last 2 years is really encouraging. Also, low prevailing market share mean a significant potential for e-bus penetration in the coming few years. By now, most of the issues with respect to e-bus rollout are either addressed or understood by the industry players. We saw in the presentation the analysis of total cost of ownership of diesel versus e-bus, which clearly makes a serious business case in favor of e-buses. While there are few gray areas or open issues wherein we would like to know the views of our today's panel members. So with this background, let me request Vivek to share his first views on the e-bus rollout trajectory. So Vivek, currently India has over 11,000 e-buses on road, and given the ongoing progress which we saw, how do you see the e-bus volumes in the coming 2 to 3 years time? Over to you.
Thank you, Hardik and Arti, for the presentations. It was a very insightful presentation that has been put together. And Hardik, especially on the question how the number of the electric buses will be coming out, our view is that with these programs that is that has been explained in Arti's presentation, we see that the PM E-Drive 14,000 buses that has been earmarked outlays has been given and also the balance of the PM USA, but the more than 5,000 buses are yet to go, and especially and also parallelly the MHI, which is a target of about 8 lakh buses, which is taken up by the World Bank in separate forums. There is a push where the STU 6 lakh and the private STU 2 lakhs and the private 6 lakh vehicles that has to go on the roads. So these are the drivers by which the demand is being created by the government, or the government is giving a push. See, at the outset, what is more important before the demand is, the government is trying to create a demand through the various schemes. But what is more important is about the TCO. With the TCO in very clearly in favor of the electric buses, and there is a simple case where electric buses are going to be the call for the day in the times to come. And it's not about 11,000 buses, but this the number that you have shown in the presentations. Our view is that the numbers are not only going to be met, but it is going to exceed those numbers. There are challenges which are known, but somehow I understand the challenges have not yet been properly understood by the other stakeholders of the system. Like, for instance, we'll be discussing. If I hope there'll be other questions there around those challenges. If those challenges are mitigated in time and or properly understood in the same spirit in which the persons who, or the operators who are facing the challenge, I think there should be not a problem for meeting the demands that of the of the what you call is shown in the presentation of Arti. So that's a high level view as far as uh, our view is on the demand side.
Understood. Understood. So you're largely echoing with the volumes which we are expecting. You are saying it could be safely achieved, and if certain loopholes are addressed, then the volumes could be even higher than that. Got it. So as a follow-up to this question, my next question is for you, Shini. So India has a significant potential and capacity, which we saw in the presentation in terms of the capabilities of catering to e-bus requirement. However, the growth has been gradual. So according to you, what is required to accelerate this rollout? And what are the key insights and lessons do you think the companies have learned from the past few years rollout? So what exactly is required to fast track this? Over to you.
Thanks, Hardik, and thanks, Arti, for the presentation as well. It was really insightful. And with reference to the capacity or the ability of the manufacturers, we are there with reference to, let's say, the key challenge was battery initially, but then we have crossed those stages now. India is more or less having, let's say, the assembly of battery to be done in India itself. So there is no challenge there as of now. But given that position, how the adaptation is to be pushed is not the manufacturing capacity, which is a hurdle at this point of time, but the adaptation, how quickly the STUs or the customers are willing to implement it. The let's say how the infrastructure is being kept, how the STUs are willing to take the part in the power side. All the ecosystem is what is going to be coming through in a let's say a parallel manner, which needs to be pushed out, while also the schemes of the government should also be pushed to the manufacturers in a timely manner. That's what is my viewpoint on the ability to cater to the adaptation.
Understood. Point taken. So now let me move to Hemanth to gain some understanding on the GCC model and how it actually works. So Hemanth, despite numerous advantages of the GCC model which we discussed, why e-bus penetration is limited to only few states and few cities in the country, and what could really help for a nationwide e-bus penetration going forward, which can really give a big push to the sector? Over to you.
Yes, thanks, Hardik. Well, the GCC model is a good model. In fact, if you see the way it has progressed from last few years, there's a tremendous changes happened thanks to the maturity levels, how it was few years back and currently. Like one good example is that like few years back, any tender that the government was issuing or the STUs were issuing, OEM participation in major stake is very, very mandatory. Because a few years back or 4 years back, when the whole country decided to go for electrification, this industry is completely new. So no one is aware of how to take it forward, and hence, quite understandably, the government made OEM to be a major stakeholder in that SPVs, which are going to run on behalf of the government, right, by the SPVs. So and significant changes happened, like last few tenders that has come. OEM participation is not required. Matlab, it's up to them, but there is no mandatory that OEM should be the major stakeholder in the SPVs which are running on behalf of the government. So that's a very good change, because the markets are mature and people now are understanding in terms of the pluses and minus of this whole GCC model. And um, it is not limited to few states. Like in the last 6 months, I could see the kind of tenders that have been issued, and it's across the state, across the country. It's not just few states. I think it's slowly, with the improvement happening with whatever the tenders what happened in the last 3 years. Whether you take about Rajkot, or whether few of the states where tenders went successfully. If you talk about PMI side, we went very successfully and we have delivered very good number of buses in few of the states. I think that success story will has carried forward now, and most of the states have come with the tenders. Like in the last 6 months, I could speak to my operations team, who are involved in the tendering team. Basically, all the states have come up with the tenders, and it's not like few buses. It's a very huge quantity of the buses. Like one such I can name in Andhra and Telangana side also, they have come up with 1,000 odd buses kind of tendering. So that's a good indication. And maybe northeast side, not that much penetration, but other than northeast, you will see across India, good demand has been getting generated with these e-tenders.
Understood. Understood. So hopefully next time we'll see more states in the spreadsheet once these buses are actually delivered. So good to know that. Now let me move to Vivek to understand how private sector participation can improve. Currently, majority of the incentives are for STUs, which is limiting the volumes in a way. So incrementally, what kind of incentives can be provided to private bus operators, which is a sizable portion, to fast track the deployment of e-buses? Or do you really believe that without incentives, also cost dynamics are now in favor of e-buses for private players to move? Over.
Yes, Hardik. So the question with respect to the first of all, before I answer this question, let's understand the high level number. The number which appears to us at a very ballpark level is about 18 lakh buses are there today. That is, in this bus space. So 18 lakh buses, and if you broadly divide this into three broad categories, although it may vary, generally one third, and one third. So about 6 lakh, a little less than 6 lakh buses are around for the STU. The second is for the second pie of the one third is for the private sector, what you call the intercity, and the third one third is for the staff and the tarmac and all the corporates. So if we were to, for the purpose of understanding, if you divide into three categories, now the private sector has a very pivotal role to play if this bus adoption has to increase in the private sector. So having understood or this thus far, especially to increase the adoption in the private sector in this particular intercity private sector, so it will be helpful. The second point which I was coming back, trying to explain this here, is that it is not only the incentives per se, but there are a lot of other factors and push that can give in here. Like for instance, for the private people, because what is happening is if it is moving intercity in the private, if it is moving intercity, the asset stripping is a little higher, because when it is in a city, say it is 200 kilometers, and if it is an intercity, it is 500 kilometers plus. So the asset stripping is good and better. But more important is that these are the private operators. If they were to come and participate, it would be useful if certain the models which are undergoing a change comes quickly into the play. For instance, we see that today it is not only the banks who are should be the people who today they're front leading it, but there are leasing companies who are already in the forefront now, but they can come forward and start lending the private sector also. So if this is possible, I think this will move in a big way for the adoption and penetration of this and the private sector in the intercity operations, which is a major play, and it also somewhat profitable if the routes and other things are in that manner. That is one. Secondly, also in addition to what we have just submitted, is that the sector, the per se, has not yet been given the infra status. If it is given the infra status, then what happens is a lot of money uh, and allocation can be made in this particular sector by the financial institutions. So that is, I think, the representation had been made and for the getting into this budget also, but somehow it has not found its space. The scrappage incentive, especially, also needs to be more closely watched and understood how the diesel buses, the scrapping, and then finally into the electric, some sort of incentive, how it can be given, so that can be helpful. And the charging infra is a big piece when it comes to, because the utilization of the chargers are a little less. So if the government can come forward, especially in the intercity operations and in the private sector, so how do they, they a certain thought process. Niti Aayog has invited a lot of deliberations on this in the recent past. How do you increase the utilization, which is currently less than about say 25%? So especially for the chargers, and that too also on a fleet charging. If it is in a public transportation, the assurance of the charging utilization for the chargers is not significant. So all these put together, it is not only the subsidy per se. The subsidy can be in some format, but more important is to see that the ecosystem for the intercity buses, which is the prime mover and which is the which is having the most TCO advantage. If these people are given some sort of facilitation, then we can see the penetration swiftly move up, especially in the private sector. That's our submission, especially for this type of penetration in the private sector.
Right. A very comprehensive view, Vivek, and a lot of takeaways for all the stakeholders from this. And now let me touch upon very critical and pertinent issue about the counterparty. So Shini, if you can come into this. Here my question is that there have been ongoing concerns about the counterparty risk. They may be paying on time, but there is always one or the other concerns whether the payments will come tomorrow or not. So particularly when they are under a financial strain. So how this risk can be addressed to fast track the STU rollout of the buses, wherein OEMs can go big way.
Yeah. Hardik, what is happening is that the counterparty risk with reference to government is there, but there is no failures. First of all, let's try to understand that. And yes, there has been delays, but it's kind of a sector where we need to maneuver it around to have this skill set to collect it on time. Secondly, there are systems like say payment security mechanism that has come through now, especially in the PME bus seva, which Harti was also touching upon, wherein the counterparty risk is kind of addressed in a way that there is a security mechanism, at least for let's say an outlay of 3,500 crores, more or less, that's been done. And this is to cater around, let's say, 38,000 vehicles. And what essentially it does is to cover the payment of this buses for at least 3 to 6 months' time, if there is a failure from the STUs. So the coverage is from the central government, wherein if the failure is there from the counterparty, the STUs, the payment can be pulled from the escrow from the this fund, PSM fund, and thereafter it get replenished from the direct debit mechanism. So this is now being formulated, but the implementation needs to be seen how fast it has to get implemented, and that's where we are seeing the challenges. There are good thinking process that is happening, but the implementation takes a lot of time when it comes to these kind of things.
Right, right. Understood. So a follow-up on this for you, Vivek, as Shini has touched upon the payment security mechanism. So do you believe it will really alleviate the counterparty risk, or as an OEM, you would like to see the proof of the scheme actually working the way it has been drafted? So how comfortable you would be with this?
See, the counterparty risk, especially with respect to the PSM, this has been, there are two PSMs, PSM Bus Seva 1 and PM Bus Seva 2. When it comes to the PM Bus Seva 1, basically there's a small technical challenges which are being faced, as Shri was saying on the ground. What is it, the policy? And at a high level, it is the concept and the design is fine, but when it comes to implementation, there are challenges on the ground. So the PM Viva Seva 1 is there are certain challenges when it comes to documenting, because banks do the financing. See, 80% in the project cost of say 100 rupees, 80% is the financing that is done by the banks and financial institutions. So they want a very clear-cut mandate that is written in the concessions, where a DDM, the direct debit mechanism, has to be very strictly and clearly implemented or incorporated in the tender, in the concession agreements, which is and they don't want any ambiguity. But many times we find that in the PME Seva 1, these are not properly documented and covered. So there are challenges when when one goes to see, as far as the documentation part of the PM Seva 1 is concerned, with respect to the DDM. As far as there are certain workarounds, certain discussions that is happening at a various authority level, and we feel that the solution will be arrived where where the financial institutions will be taking a view and will be going ahead with respect to the agreements. I am going to understand the PM Seva 2, which came well after the what you call announcement of the direct debit mechanism. Their contracts will have already captured, and so that should be a problem, should not be a problem. But going forward, it is the payment security is one particular thing, but there are, to elevate the counterparty risks. What is more important parallelly is to see that what is, the infrastructure, the power, all these sector, the other things also need to be matching alongside, which is the responsibility for the STUs and other stakeholders. Why I say so is that these are, the entire risk is on in the people who are running the buses. The GCC model is a model which seems very good, especially when it comes to leading the show from the front. But when it comes, there's a huge, and there's a limitation. If these don't really work out well, then the covenants and all these the challenges are tremendous. So when the risk is on the operator or the people who are running the show, the party on the other side, that is the STUs, also will have to realize that there's there should not be a or the misalignment of the risks. There is currently a lot of risks are there which needs to be properly understood there, and as a result of which the counterparty risk is most important. Counterparty risk has been taken care of through the payment, the PSM mechanism, but others, with respect to delays of the infrastructure and other things, the allocation of depots and all those things need to be, are still which needs to be properly addressed.
Understood. So I have questions on the other risks which you broadly touch upon. So we'll discuss on those also. So Hemanth, now let's move to another important aspect about the pricing. So here my question is that do you believe that the industry has matured in terms of pricing strategies? Last 2-3 years we have seen the pricings have gone up, or we may see some price war in the coming biddings of the tenders by STUs. What's your take on the pricing side?
I personally believe yes, maturity has come compared to how it was maybe 3 years back. We could see a very reasonable tendering happening and reasonable pricing that is being accepted by the government. And one good thing happening is that thanks to the central government, which is pushing on this, so they are open to understand and listen to the pricing. For example, if there is a certain pricing which we have come, and they're open for the negotiation on that. If the necessary ROIs and ROCs are not matching, then we can always go back to the government and say that, hey, this is what it is. The kind of number that you're expecting may not be giving us necessary return on capital. So they're pretty open. As I said, I think the push is there from the central government, and hence the government is pretty open on if there are any challenges in terms of the pricing, which will severely affect the return on investment, then I think the government is pretty open on that. And to answer your question, yes, there is a good maturity compared to how it was 3 years back. And I could see that in the latest tenders. And the good thing is that this tendering pricing is completely different in each state. It is not like spread across the same, right? Tier 1 certain pricing, tier 2 certain pricing. For example, Mumbai tendering that we have participated has a good pricing compared to the tendering in the tier 3, tier 4.
Understood. Okay. So as a follow-up to this on the pricing, Shini, if you can take this. So considering the rates which have now stabilized at around 70 rupees a kilometer, up from as low as around 40 rupees a kilometer a few years back, how do you see the rates say next 2-3 years? What's the ballpark range where you see the rates moving, and what would be the critical factors which will influence the rates per kilometer?
I think my viewpoint is like this. While the rates have improved, but I think it is not in that level where it is settled for a long term. Yeah. The challenges here are there. It's a very long term contract. The gestation period is very long, and keeping that in mind, if you take the pricing and in comparison, let's say what is happening in a PPP contract of diesel or CNG for that matter, we are at a very low levels. And what essentially we bring in into the table is that if you compare to a STU who's having his per kilometer rate around, let's say 120 rupees, 130 rupees, we are quoting at 70. So essentially we are missing something at this point of time. And I feel that the next, let's say, tranche of PM EVA Seva or the PME drive, the rates will increase at least say by say 10% or so. But eventually I see there is a potential of at least 20% to be improved upon on a long-term basis.
Understood. So there is an upward bias is what I take this. Right. So my next question is for you, Vivek, on the charging infrastructure, which you broadly touch upon. So specific question is, we have seen the STOs delaying the provision for the depot infrastructure and ultimately leading to the delays in the deliveries by the OEMs. So are these challenges still ongoing, and aren't the STOs accountable to take the deliveries as per the agreed timelines in the contracts, in spite of the delays in the charging infrastructure from the airport? There are delays in handover of land, there are certain other issues, and ultimately it comes back on OEMs and the deliveries are delayed. So what's your view on this?
Yes, so as I was telling you, this is there is no standard because every state has their own different way of operating things. So some states are better, some states are not so cautious about the entire risk that the operators are taking. So there's no one single formula or where we can say there's a delay all over the place. But there are delays as a result of which the problem. Just try to understand one simple consequence of the delay is that the financial closure has to be given within a particular time period, say 180 days or 120 days, or once you get the LOA. Now, what happens is once you've given the financial closure, the banks are today, they have allocated the funds for a particular period of time, and these are not lifted. Then a certain level of commitment charges gets into the picture. So there's a whole lot of risks that the operator is taking. This is just one example. There are other challenges which are being faced. To answer your question, there is not only small delay, there is a significant delay for in a number of projects that we have seen. But how do you mitigate all this? The mitigation should be that parallelly there should be an accountability that is at both the levels. It should be the same, which is implementable and monitored by the some authorities, and the infrastructure orders and tenders should be given parallelly with respect to when the tenders are awarded for the buses. Some sort of mechanism should be put in place so that these delays do not happen. Today we have experience, and we have there are where there's a delay of say more than 9 months, 8 months. These are significant delays. So the idea is maybe we need to work on this mechanism, some sort of mechanism by which these delays can be minimized if cannot be eliminated.
Understood. It affects the entire pipeline in a way, entire pipeline who is involved into this. So point taken. Hemanth, my next question is on the technology. Battery degradation is one of the concerns as far as e-buses are concerned, as it impacts the TCO analysis altogether. So could you explain the challenges associated with the battery degradation and the cost involved in replacing the batteries? And additionally, what kind of strategies an operator can employ to manage and mitigate their costs effectively?
Right, you're absolutely correct. So that is one negatives in this whole picture. And theoretically, the way we tell outsiders is that every 5 years you need to change your battery for whatever the reason. But this is completely unknown at this point of time because most of the buses which are on road is
Correct.
not has not even completed 5 years, right? While
Correct.
theoretically, while we say that, but in practically, we could see the life of battery more than 5 years. But again, this is again a theory. I might say 7 years, I might say 8 years, I might say 4 years, but nothing has been proved yet because the life of the buses which are on road has not yet completed. A majority have not yet completed. So it's a completely unknown story at this point of time. Positive side is that the cost of batteries are reducing with the kind of local manufacturing and assembling and all. At least like few couple of years back, we used to import everything, right? But at least now, all the major companies have the battery assembling in India right now. So only the cells which we don't have in India, every country has to import. So that is the plus side in terms of the cost reduction in of battery. By the time the replacement of battery comes, hopefully today, which is 35% of my battery cost, which is 35% of overall costs, might
Correct.
come down, 5 to 10%. If that happens by the time this 5 years complete, then we shouldn't see much change. One of the ways to mitigate is creating the necessary reserves from the financial point of view. As a finance guy, I think that's one of the things that we push the SPVs to create necessary reserves from the profit, because most of these SPVs which are running on behalf of the government get profitable from mostly from third year onwards. I'm talking more from a PAT positive, because first 3 years, because of your interest and the depreciation which is chargeable from the day one, you will not have enough EBITDA to cover these two. But I think second or third year onwards, you will get necessary PAT positive. From that, you can start creating the reserves so that, though on the paper we are saying 5 years, let's assume in the seventh year, if it gets and I have necessary created reserves to cover my financial liabilities or a financial risk, that is one of the ways as a finance guy which we would be taking necessary efforts, right? From the operations side, like one of the mechanism which we do is that frequent checking of the life of the batteries. On a regular intervals, we do have necessary technology to check that and see what the life and the efficiency of the batteries. Through that, we can take necessary efforts from the operations side.
Understood. It's a good wish list so that battery prices coming down, say, constituting 10-15%. So point taken. Shini, a related question to this. Can you give some insights on India's progress in localizing the components using the manufacturing of electric buses? And how do you see the viability of battery leasing model, which is also being talked about?
Hardik, with reference to the localization, I would say that but for the battery sales, most of the items are getting assembled here in India now. And with the PLI scheme of the government, I think it's becoming more and more prevalent that all the EV components are going to get manufactured in India. And what we are seeing is that other than batteries, the other components might get cross-pollinated with the cars or with the other segments, wherein it becomes much more easier for us to manufacture. Saying that, there is also challenge with reference to this battery prices coming down as one assumption while we make it. It is going to be a challenge as well, because even with scales, with the way in which the forex is moving, it's going to be a challenge in the long term. That's what we are foreseeing at this point of time. And the other parts, the technology needs to come into India. At this point of time, it's kind of localization for the purpose of, let's say, testing or assembling, or kind of the last bit of manufacturing is happening. But the technology needs to get improved in India. That's something which is for the long term, which will get pushed. Now, saying this, coming to your next question of battery leasing is something which is going to be there. And mostly this is now being followed by most of the big OEMs now in the other segments, other than the commercial vehicles at this point of time. And in the commercial segment, yes, it is going to come very soon with reference to, let's say, the small commercial vehicles. But the large commercial vehicles, it's going to be a challenge. And the impactfulness of this leasing model needs to be articulated well with reference to the NBFC's participation into this. with most of these NBFCs are not into this segment at all at this point of time. So that needs to be a big push, either by creating this as a priority sector, or infra needs to get recognized by the government as this sector to be recognized as a infra sector. And the charging infrastructure also needs to be recognized as a public charging, thereby you get the necessary subsidies towards it. So all these things needs to be put in place on the long-term basis, which will necessarily bring the localization back.
Correct. So hopefully there are a couple of companies who have bid for PLI for battery manufacturing. This is an integrated setup right from cell. So hopefully those are also expected to come on stream in next 2-3 years by the time your battery replacement requirement also comes up. So if those things are in place, then it would be a good thing for the e-buses. So now moving to the capex and its funding, my question to you, Vivek, is that GCC model is an extremely asset-heavy business model for OEMs. Unlike you had been earlier manufacturing and outright selling the buses. So given the significant potential of e-bus rollout in the medium term, how do you see the OEM's ability to fund this large size of capex? Because now you'll be having this large size of block to be there on your books.
To this specific question, I understand that the lot of deliberations that has happened in the various forums, and the government has also taken a view where it is all the OEMs will not be in a position to take the assets on the books if we have to scale up to the level of what we have just articulated in the previous discussions and the presentation. That's a huge amount of capex that is going to be involved. If suppose may 8 lakh buses is there, that is to be 8 lakh and say multiply by 1.5 crores. So that's the number. So no OEM will be in a position to participate as through the GCC model per se. So that's the inability of the OEMs per se. That is one. And not only this, but beyond this, there are certain guarantees that is to be given, certain performance guarantees and other guarantees that is a part of this. So there's a limit under which all the OEMs will be able to participate based on their respective strengths. But what is more important is, and the government has realized this. That is why what they are saying in the tenders that is now currently in the offing is that the financial aggregators have been allowed to participate, and the OEMs have been allowed to reduce the stake to the extent of 26%. And this is something which is a welcome step. And also, we discussed, and in the previous question, that leasing is some method by which we can de-stress and still we can leapfrog uh, this entire piece, because everybody has a role to play as we move forward. There's a lot of roles. The leasing companies can play a role. The OEMs can play a role. The people who are in the operations and they run their can run efficiently. They can play a role. AMC is another line of business that is so all there are various stakeholders and they can perform to the best of their ability. And severally we see that all these things put together will de-stress and it will reduce the load on any of the higher risk on any particular one entity as such. So this will be the risks will be taken in line with the type of the business that is in the offing by the respective stakeholders. That's my view as I see the various business models emerging in the next 2 to 3 years as we speak. As of now, the OEMs have taken the responsibility among themselves, and that's how they have act as a catalyst, so to say. But going forward, the models will definitely change for good.
Understood. It would be really interesting to see the new business models which are really evolve and which can support the e-bus rollout. Shini, my question on the incentive side. Currently, e-buses are still getting sizable incentives or subsidy from the government. So how do you see the e-bus industry without government incentives or support? I'm not saying supports will not be there, but every industry in the initial phase, government has provided support, and that's how the entire ecosystem has developed. And once things are in place, then industry has to do on its own. So how far do you see we are still away from that era wherein there could be no incentives and still the industry can do it on its own?
So I think the point here is that while subsidy is a push on a sustainable basis, the business has to run by itself, right? And for us, the answer lies in the adaptation in the intercity segment, where the asset utilization or the sweating of the asset will be much better, and thereby the economics will be much better in terms of the overall ROCE. So that becomes the key point. And if you see the intra-city segment is somewhere where the adaptation is happening quite rapidly. Let's say 50-60% is EVs today out of the total sales on a year. But the intercity needs to get a push. And for that, we need to create all the infrastructure things and the peripherals which needs to be get aligned properly. That's the overall thing which I would put it into.
Point taken. So I'm sure the audience has been anxiously waiting with some questions. So let me start taking 2-3 questions. We are short of time. So quickly I'll take the questions. So question is for you, Hemanth. Do you see the potential reduction in cost of e-buses in the near term, given there is a steady decline in the battery prices, which we saw in the presentation, and which is one of the key cost component, 35-40% of the total e-bus cost? So we have seen a significant decline over the years, but from this level, how do you see further reduction in the cost of batteries and ultimate reduction in the cost of e-buses?
Well, it completely depends upon many factors. One is the localization. One of the important thing is the localization, because if the localization doesn't come as expected, then you start again depending on the imports, and as you are seeing the exchange, the US dollar with the INR is going so crazy, right? So we do not see much of the impact. So the key here is the localization, how quickly we can do the localization, and in a phased manner. If let us assume that the localization we will be achieving as planned, then in that case, the answer is yes, we will see a decrease on the overall cost of production significantly, and hence, once the volume increases with the lesser price, so that there will be enough revenue or enough money to cover my fixed cost. Fixed cost may not increase in the similar manner. As a result, I can still get the profitable margin, even though if I can change my pricing of a bus, right? So I think the key here is how quickly we will go localization, and if localization happens as per plan, yes, there is a huge scope for reduction of cost of bus.
Understood. So for paucity of time, this is the last question, which we'll be taking from the audience side. So Vivek, if you can answer this. The question is, will the alternative fuels like hydrogen fuel or biofuels pose a challenge for EV adoption in the future?
See, I don't think so. At least this is an issue which is best discussed and debated. The alternative technologies are yet to establish. We don't foresee on a mass scale that is going to happen at least in the next 3 to 4 years or 5 years also. 3 to 4 years, something which is very clear that we don't have any mass scale adoption like we have in electric space. That is what was being debated by the MHI also some time back. Whether which sector we have to move, whether it is electric or hydrogen or some other alternative technologies. At the level which the government has now pushing, and a lot of what you call industry, the entire industry will push towards electric. I don't foresee in the next at least 3 to 4 years, maybe in a long term, the use case, if it is improves, hydrogen can come in a long way. But at least this EV technology is going to stay for the next 10 years, and it's going to lead the show. I don't foresee this coming up at least in the next 4 to 5 years, at least. On hydrogen or the
handling hydrogen itself is a big challenge, is what we also understand. So we are largely echoing with the views here. So thank you again to our guest speakers for their insightful views, and it was a privilege to host you all. I'll now hand over to Mamta to give her concluding remarks. Over to you, Mamta.
Thank you, Hardik, for moderating the session, and Arti for your presentation. Once again, thanking all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please write to us in the feedback mail. Goodbye for now. requesting the team to kindly log off.